First of all, nobody can tell me about my wig because me make sure say I go get it professionally done. I feel like say nobody can come hype on me no more. I'm do my hair professionally. Today we're gonna talk about the financial aspect of acquiring property as promised. I promised you from like last week. By the way, guys, thank you so much to everybody who has subscribed. I really did not expect so many people to subscribe. I didn't expect 200 people to want to hear what I have to say, but I am super grateful. I am just ecstatic that I have another platform that I can just spread the love. So if you remember from my last video, I walked you through the entire process of buying real estate, from the sit down with yourself and figure out what you want to buy to the closing the sale part. So today what we're going to talk about is, as I said, the dollars and cents part of it. There's some things that people don't understand, which I mean, I think it's an injustice to lock yourself in such a transaction without understanding the real implications that the transaction brings. Now let me just say first of all, but this, I must say this in every video, don't make nobody force enough to run up in a no mortgage. Don't make nobody force enough to run up in a no additional expense we cannot manage. It's more embarrassing to see the people and repossess on the house. Gonna hear me? The first thing I want to explain is how a mortgage actually works, because I don't think many Jamaicans understand how a mortgage actually works, especially young Jamaicans, young persons trying to get into real estate. When you're going for a mortgage, the bank typically tells you that, every month, if we approve or after they approve, they tell you every month you're supposed to pay, let's say $100,000 for your mortgage to the bank. Let's say your bank is JMB. They tell you that JMB tells you every month on the 25th, you need to pay $100,000 to us, JMB. That $100,000 isn't just you repaying your loan. That's what a lot of people don't understand. It's not just you repaying your loan to JMB. There is a breakdown of different fees that you would have been paying over the course of your mortgage. So for example, you would be paying interest, which is a big part of it, guys. Interest. You would be paying life insurance premium. Yes, most people don't know this because, as I said, it's wrapped up into one and they give you a stack of paper to sign and you just whoop, 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 whoop. You never know say about life insurance, but it actually works out better for you if you go in and assign your policy. That's another video, but it includes your life insurance. In some cases, it can include your peril insurance, which is your house insurance, especially if you're trying to buy an apartment. It can include your NHT too if you're trying to get your if you're using NHT as a part of this transaction. That's the thing. The most popular financial institutions, they have a relationship with NHT. So what happens is that when you are claiming on your NHT, you're using your NHT points. You don't have to be paying NHT every month plus the bank every month. You just make one payment to the commercial bank and they sort it out with the with NHT. Sometimes they pay for it like in full at the beginning and you just repay them everything every month. So as I said, if for example your mortgage is $100,000 per month, that $100,000 is not just my loan. It's broken down into the JMB loan, NHT loan, your insurance policies, that kind of thing. And sometimes it comes with compulsory savings. So it's broken down a whole lot. So your mortgage payment can change depending on what your situation is. If, for example, you no longer need their life insurance policy, which is known as creditor life, let's say now you want to assign your life insurance policy, your mortgage payment would no longer include the creditor life insurance policy because you no longer have insurance with them. So that's another way that your mortgage can change. Next thing that I really want to address is something that people really don't understand. And this is something that I've seen. I'm gonna say first of all, you have some Jamaican Karen out there who go boast and brag upon you till they say, oh, them own house and them own them $20 million house and you know them better off than. Don't hype on people because of what you have. Okay, that's my pet peeve. Do not hype with what you have. At any given moment, it can all be taken away. Now, I said all of this because the Jamaican Karen may be in a situation where, not maybe, Jamaican Karen, the situation I just explained, she would be in a situation where if she took out this mortgage in 2018 and she wants to sell this place in 2020, she's been paying her mortgage all this time, every single month on time. It's been what, 2 years? So she'd be like, all right, if I've been paying $200,000 every month for the last 24 months, then, and I took out a $20 million mortgage, then when I sell this place, I only owe $15 million, right? 15.2 million. Well, no Jamaican Karen, when you go into the bank, you're gonna see the bank is gonna tell you probably, hey, so you owe $19 million out of the 20 that you just bought. You probably still even owe $20 million, to be honest. You probably even owe more than the $20 million because every month you have been paying your mortgage, you have been paying interest first. You have not been paying on the principal. And if you have been paying on the principal, it's a small amount that you have been paying. Majority of that mortgage monthly goes to the interest. Therefore, Jamaican Karen, with your 5% equity, your financial position has not changed. Okay? So stop hyping on people. But I'm not saying that you can't purchase real estate with 5% or 10% equity. I'm saying that you need to fully understand what you're doing before you do that. Worse with 0% equity. Because if you have 0% equity, if you take out one of those 100% loans or 110% loans for your property, your financial position has not changed. I don't know if many people realize this. Your financial position has not changed. Let's break it down. You do 5% equity, say you buy somewhere for $20 million and you do, as I said, 5% equity, you'd have paid $1 million out of the $20 million. If you're gonna sell back this place, you have to pay transfer tax, and the transfer tax plus all the other fees you have to pay is gonna easily suck up this $1 million. So your financial position hasn't really changed. Because I consider 5% equity, 10% equity in real estate a good savings mechanism, because over time you are acquiring a little bit more of this property. So what's happening is that it's like a major savings goal that you have. In 25 years, you would have saved $20 million type of a situation. You understand what I'm saying? But if you're looking for a financial move in your portfolio in the short term, that traditional way is not the way to go. As I said, the traditional way. There are other ways you can make money from real estate in the short term, which will be in another video, but this is not the way to go. Okay, so let's talk about the loan duration. Let's talk about the loan term, because you may notice that your friend goes in for a mortgage and your friend gets 25 years to repay. Your other friend goes in and your other friend gets 30 years to repay. Your other friend goes in and your other friend gets 10 years to repay. Now, that is actually quite normal, because what you have to look at it this way. The bank is only assessing your ability to pay them back their money. That's what they're assessing. So what they look at, they typically look at two things: your job and they look at your age. Now, what usually happens, for example, a category I can use as an example readily, for sports, people in sports, for athletes, if say based on your field or your sport, the cutoff age, I don't really know the sports jargon, but the cutoff age is say 25, and you're 20. Ordinarily, as a 20-year-old, say a 20-year-old attorney would get, let me not say 20-year-old, a 25-year-old attorney would probably get 25 years, 30 years to repay his or her mortgage. Or a 25-year-old bank teller would probably get 25 to 30 years to repay his or her mortgage. But an athlete in a particular sport, if the cutoff age is like 25 and you're 25, you may not even get this mortgage at all if this is your only source of income. say you're a basketball player, which I don't really know the facts of, but let's say you're a basketball player and the cutoff age is 26 and you're 25, you've been getting good income, great income all this time, but you're brought out your money from one whole pan gal. You brought out your money a party, a dance, you buy up bar like a unit. You just have brought out all the money, so you don't have any money, or you're depending on your income. The bank will look at that to say, when he gets 26, what are the chances of him being picked again? I don't know the jargon, but what are the chances of the team hiring him again to keep playing basketball given his age and given the industry? Alright, like 5% chance? Alright, so it's 5% chance that he will earn an income. So it's a 95% chance that he will not have any income. And remember, homeboy did have brought for the whole of money out the road. So it's not as if he used that source of income to establish another source of income. That's all the bank really cares about, is the source of income. So if the source of income looks like it's going to dry up, the bank is not interested in giving you a mortgage. Or let's say the cutoff age is 30 and you're 25, the bank may very well be giving you or offering you a mortgage for 5 years, which I have seen happen. Yes. Now let's say you are 45 or 50 years old and you're trying to get a 30-year mortgage, a 30-year term. The chances of you getting that, very slim, because again the bank looks at your ability to repay your mortgage and you having a source of income. What are the chances of you having a source of income as an employed person at age, at age 80? They look at retirement age and all of that, but it may be a different situation if you are self-employed, because you can work until whenever you want to stop. It's not a set thing that the bank uses to determine if you get this or that. They assess your situation. They assess each case by its own merits. They look at all the facts of each case. So, but these are the things that they usually look at: your age and your job. Let's talk about requirements, So, this is where people falter sometimes too, because banks make it look, when they advertise, they make it look so easy, like, oh, just come on in, we'll give you a mortgage. All you have to do is just bring yourself in. It's not the case. They want you to bring yourself in with all the laundry list of things that they need you to have. So we're going to talk about requirements. The requirements differ based on your employment status. For self-employed persons like me, it's a little bit tougher, but a lot tougher. The bank will ask you 1 million or one question, and after you answer the 1 million or one question, them have 2 billion more to ask you, but I just saw it go. Because again, they look at your ability to repay the money that you owe to them. And for some reason, which I don't quite understand, they think that you paying yourself is a much riskier position than another person paying you. Don't get it, because the other person will take the same risk as me. But I will not go there. I digress. The requirements that you have as a self-employed person, the most important thing that you need to have is your financial statement. Now, the bank requires financial statements for the last 2 years. Some banks may require one. It depends on the type of job, the type of business you have, and how well it's doing. They may be willing to accept only 1 year. But usually, it's 2 years that they require. Now, another thing you need to know about the financial statements is that the type of financial statement that they require depends on the amount that you're trying to get from them in terms of a mortgage. The higher the amount, or the higher the amount, they will need financial statements from a chartered accountant. And a chartered accountant is pretty much just an accountant. He might more letters behind the name. I think he go more school. I'm not really too know because I'm not in other field, but I just know chartered accountants, they charge more, and when you're doing more serious things, the bank requires things from them. Now, in terms of costs, let me tell you straight up, it's not cheap. They charge about $80,000 to $200,000 per year. And remember, I said the bank needs 2 years, so you're gonna need about $160,000 to $400,000 to get the statements done. But hear me, I say, it's not something that you should write off and think, oh, my money gone and it done and it waste. No. You need your financial statements for other things, especially when it comes to taxes. So just get it done and done. You can reuse the statements. The other thing that they will need your bank statements, because they need to see if your bank statement. What is The bank statements are needed to see if they correspond with your financial statements. So your financial statements are prepared by the chartered accountant based on your bank statements and the sales and expenses and all that you may have. But if your bank statement and your financial statement don't correspond, then something or something. So that's why they need it. They also need proof of address. They need ID. If you're trying to get a joint mortgage with NHT, they're gonna need 2 photo IDs. The adjudicator may assess your file and say, hey, so we need to see your tax returns. Sometimes they ask for that. Hey, we need to see my income letter. Sometimes they just want your income letter alone. They don't need a financial statement. It depends on the type of mortgage you are going for. If you're trying to go for like a baby mortgage, they may be willing to accept your income letter from a chartered accountant. Or they may be willing to accept financial statements from a public accountant. A public accountant not have so much less of being in name and they not charge as much. That's the extent to which I know. I don't really know much about accountants and their field. I just know how much them charge and what them do. So that's pretty much it. So those are the requirements for the self-employed persons generally. For employed persons, get ready for this. All the bank needs 3-month pay slips, 3-month bank statements. Oh, by the way, self-employed people, they need about a year's worth of bank statements or 2 years worth of bank statements. But anyway, I digress. Employed persons, they need 3 months pay slips, 3 months bank statements. They just need to make sure that where you say you work, they're actually paying you real money every month like an employee. They need proof of address, ID, 2 picture IDs again if you're gonna go through NHT. Oh, and for both categories, self-employed and employed, they need you to sign a credit consent form so they can pull your credit report. That's pretty much it. That's it for the requirements. Easy peasy. The last thing we're gonna talk about is the fees involved. Whoop! Yep. We're gonna talk about real numbers, real percentages. I want you guys to fully understand. So I'm gonna input a table with the percentages and we're gonna talk right through it. It's pretty simple, guys. You have the attorney's fees 2 to 3% plus GCT. It may be higher, it's not usually higher, but that's the range. You have the cost to prepare the agreement for sale, it's divided by both parties. You have the transfer tax, which is 2%. It's paid by the vendor only. The registration fee, it's borne equally, so each party pays 0.25%. The bank's processing fees, that will depend on which bank you decide to go to, but the range is usually 1.5 to 3% plus GCT. The other costs are that you can use as a good rule, that you put aside 1% of the value of the property to cover the other closing costs, plus 0.8% to cover the reports that the bank will need in order to process the mortgage. So yeah, guys, that's pretty much it. That's the dollars and cents part of it. I hope between this video and the video that I posted on the process that you have the full understanding as to what it takes to acquire real estate. Next week, I'm going to jump into the don'ts when you are buying property, the things you should not do when buying property. Trust me, I'm talking from experience. My experience at Palo Poly, I'm going to give you real life examples as to what you should not do if you don't want to affect your ability to get a mortgage. So don't forget to, I always laughed at my sister when she said this, but no, look at me. Don't forget to like, subscribe, comment, share, subscribe, whatever it is. Do that, and I'll see you next week.